Our next guest saying that markets will be choppy for the next 3 to 6 months, and he views a broadening in the earnings recovery as critical to his year-end S&P price target of 6,500. We are happy to welcome back Mike Wilson to Squawk Box. He is Chief Investment Officer, Chief U.S. Equity Strategist for Morgan Stanley, and it's great to see you after quite some time. Nice to see you, sir.
Yeah, good morning.
So you think the next couple months are choppy. Does that mean don't do anything and wait for some kind of dip based on this sort of longer-term arc you've got going?
Not at all. I mean, look, we made that call back in November, December, just saying, look, we priced a lot. 6,100 was kind of our short-term target. And look, there's a lot of news coming out, and we think the growth, so the policies initially are sort of growth negative, which is, immigration sort of enforcement, and of course the tariffs, and that's just a lot of noise. So we're just digesting that. Plenty to do underneath the surface. I mean, financials have been phenomenal, and we've seen it broadening out to some degree. In fact, software over semiconductors has been a great trade for us because as
software over semiconductors,
right? Because of the diffusion of tech now and the application layers being built out, and we think that got confirmed a bit with the DeepSeek, announcement. So,
do you think that the semiconductor game is taking a pause, or it's over, or what?
Well, it has taken a pause. I mean,
I know it's taking a pause, but is it forever a pause?
Of course not. I mean, it's a cyclical group. And look, away from the AI beneficiaries within, CapEx has been pretty weak for most other semiconductor type spending.
Right.
And of course, now with this DeepSeek potentially leading to the next excitement part of AI, which is the diffusion of it and the application layer. That's the opportunity, is going back into the software stack.
Like, there was a time where you were worried about, I think, earnings, which could forecast like a slowdown in the economy that could have been the R word, could have been a recession. That never happened.
That's right.
Have we learned to manage the economic cycle where it doesn't have to? Are we closer to it happening now because it didn't happen, or does it not have to happen unless there's a mistake?
Well, I think a couple things happened last year. What we missed is, we didn't miss it, but we actually called for it, which is a rolling recession. We've had recessions in many, many industries. If you think about the last 2 years, we've been in a recession in housing, in autos, in manufacturing, in consumer goods. A good part of the economy has been
So we're not closer
soft
to that inevitable day of reckoning for something happening.
No, I will say this. I think what could be interesting this year is you could have a recession in government, right? If you have a recession in government, that may actually cause unemployment to go up to a level
that could cause a recession
in
the economy, yeah.
But it may not be that bad, Joe, for the rest of the economy because they've already been in sort of this soft recession. So that's actually our bull case, is that the government shrinks. The crowding out stops. It allows the Fed to cut rates at some point, and the broadening out can actually happen. A lot to happen between here and there, but that is actually the bull case.
God, that was like a symphony to me, what you just described. Is it? And you think that's possible at Morgan Stanley?
Well, I think they're working on it. Probably the most underestimated part of the administration is DOGE. I think there's a lot of skepticism around this. But the reality is that's possibly the most bullish thing that could happen. If you could shrink the government in a way that,
it's the end of the free world and a constitutional crisis. I just heard Chris Murphy say that to me. I'm scared beyond belief. I'm scared to where there's nothing in my intestines.
Well, it's the most exciting thing I've heard in a while. Remember, in the 1990s, we had this great bull market. Now, the thing that really sparked that, in my view, was the budget deal that happened in '94. Okay, now, I'm not sure we can get to that kind of a balanced budget, but if we can make progress on that, it liberates the private economy.
That's the crowding out that you mentioned.
100%.
It's interesting. That is a contrarian take, I think.
Why is that a contrarian take?
You've been giving me the other side all morning, or giving us.
Well, no, that's not the contrarian take on the
no, the
economy,
contrarian take that the Doge could end up being a complete, almost a spring-loading effect for the overall economy is not what most people are thinking. That's what you're.
I think most people are very skeptical. Investors are very skeptical because, look, it's hard to do.
What do you think the ultimate number is that has to get taken out for that to happen?
Look, we just need to freeze spending. We don't need to really cut a lot of spending. We're running so far above trend on actual expenditures. Let's just freeze it, or at least slow it down. We're growing at a much faster rate than the economy is growing. That's the crowding out feature, which, by the way, has kept rates higher than they probably would have been otherwise.
That's why the long end is running up, and if we don't do something immediately, that will be the problem that pops up.
That's right. The back half of last year, we saw rates actually start to move up, and that was our call. Why we thought 6,100 was doable is that a Republican win, a Trump win was positive for growth, but maybe not so great for rates. But now the market is kind of second guessing that and saying, well, maybe they can be successful here. We just don't know. Yeah. And it's going to be messy. That's why we think it's going to be choppy for another 3 or 4 or 5 months, because we don't know the answer to this. But this is the direction they're going.
Right. Is there places you would stay away from right now?
Well, I still think low-quality businesses are under a lot of pressure.
Low-quality businesses are always under pressure.
Not always. I mean, remember in 2021, when inflation was accelerating, those businesses...
You just think anything would move, right?
They did phenomenally well. And we saw a little bit of low-quality work in the fall when there was a grab for risk. So, in fact, if you go back to last summer, right, we were basically, recession fears were kind of rampant. And then the Fed cut rates 50 basis points. Low-quality did really, really well in the fall. And so I think that takes a back seat again. So we're avoiding that type of stuff.
Let me ask you one question related to your semiconductor view on the pause. Does that also extend to data centers in real estate?
Well, look, there's an AI CapEx deceleration going on. That's not negative growth in CapEx, it's deceleration. But stocks live at the margin, right? They live in the second derivative. And that's what I think, that's potentially what's been weighing on the space, whether it's data centers, electricity, utilities, things like that. They get a little overcooked. That creates opportunity in other areas like financials, where money had to move, big liquid group that the money can go into.